uh, if you see the Excel sheet, it's giving you the rates of tax. Okay. Now these rates of tax are basically for individuals, people like us, HUFs, Hindu undivided family, and some other people. Okay. So now the only thing which I just wanted to tell you was that this is the slab rate. Okay? This is the slab rate which is applicable for the current year and for the assessment year 2025-26. Okay, so it is up to 3 lakhs the tax is nil. From 3 lakhs to 7 lakhs the tax is 5%, and from 7 lakhs to 10 lakhs the tax is 10%, like this. Earlier which the slab which I shared was this. Okay, this is applicable for the previous year. Okay, so this was my mistake. So now what I've done, I have updated the right slab. Okay, so last time, so I've updated my Excel sheet also. So this is the income tax rates. So Mananya, tell me, for up to 3 lakh rupees, and this is on the new regime. Okay, so this is for the new regime. Now up to 3 lakhs, suppose your income is 3 lakh, how much tax you are supposed to pay?
So
Zero.
zero
And
tax.
from between 3 to 7 lakhs, what is the percentage? Okay,
So
now you can, that
5%.
means you can all see that. Okay, so these are the rates,
Yes.
and by mistake, Mananya, you were there last time.
So
Okay,
I
no
was not
problem. If you're
there.
not there, then I had presented, a slab rate like this. Okay, this was a slab rate which I presented, and then I, was just going through my, earlier, file. Then I found this was actually a 1 year back. Okay, so the latest one is this. So that was my mistake. Okay, so that means, and there's not a big difference here. If you see, this was the which I presented. So up to 3 lakh nil. Okay, 3 to 7 lakhs. So earlier it was 3 to 6 lakhs, 5%. And this is what was applicable for this current year. Okay, 7 to 10 lakhs, and this was 6 to 9. Okay, and from 10 to 12, this was 9 to 12. Okay, and then 12 to 15 and 15 and above, the slab rate was same. Okay, there's no change. Only in these three categories, only a lakh rupees was added, 3 to 7, 7 to 10. Again, here also 1 lakh was added, and this was from, instead of 9 to 12, it was 10 to 12. Okay, now it's 10 to 12. So this is the slab rate which is applicable under the new regime. That means, if suppose some of the students were not there, like Mananya was not there, and many others would not be there. So, there are two tax rates in India. One is called the new regime. So you have to opt for any one of them, whichever is beneficial to you. Okay. Now, government wants that ultimately they would like this to be there. Okay. And, for they would like that everybody should go for the new scheme. And this is the new scheme. Okay. Fine. And in the new scheme, up to 7 lakhs, there is no tax liability. Of course, if you see 3 to 7 lakhs, the tax would be how much? 5%. So, Manina, tell me how much, suppose your income is 7 lakhs, what will be your tax?
So
No,
35,000?
difference between 3 lakh to 7 lakh is how much? 4 lakhs, isn't it? So on 4
4
lakhs,
lakhs. Yes,
if you
sir.
have 5%, uh, then what will be the tax?
So
Yeah,
20,000.
20,000. Okay. So that means, the tax, here, suppose if the tax is, okay, 3 to 4, up to 3 lakh nil, then 3 to 7 lakhs 4. So that means, this figure would be then, that there will be no tax up to this thing, because you will get a benefit of 100% of the tax amount. Now, this figure is coming 25,000. So actually, this should be 20,000 now. Okay. Fine. So if I suppose I make the tax as 20,000, as I told you, okay. So you will get this 20,000 tax rebate also under the section 87. Under section 87. So that means if you are having an income up to 7 lakhs, then you won't be, be paying any tax. Okay. Fine. So because you get another benefit, that if your income is below 7 lakhs, then, like suppose if I put the figure here, uh, income is 7. So yeah, tax is 20,000. Okay, fine. Achha, earlier it was actually, that's why coming. Okay, 3 to 7, 7 to 1. Okay, so is that clear? Fine. So let's take an example. Okay, let's take an example. Suppose your income is 16 lakhs. Okay, read this, Mananya. What is written here?
Yes, sir. Mr. X has a total income of rupees 16 lakh for previous year 2024 to 25, comprising of income from house property and interest on fixed deposits. Compute his tax liability for annual year 2025 to 26 under the default tax regime under section 115
Now,
BAC.
actually, this is not the annual year. This is called the assessment year. Okay. So assessment year
Right, sir.
means assessment year is 25-26. Now, the year which is currently running is 24-25. Okay. Fine. This is the 2024-25. So this is the year which is currently running. And whatever income we are going to, make in this year. So still, few days left from March. Okay. So we are currently on 12th of March or what? 15th of March. आज क्या date है? Okay, whatever. So 2025 and 26 will be the assessment year. So this is called the assessment year. Okay. And this is called the financial year, or we can say previous year. So whatever term we can say. So whatever we earn in this year, we are going to be assessed in the next year by the income tax department. And we have to file our return by July 2025, whatever the income we have earned. So this is called the assessment year. Okay, fine. So that means his income during the year 24-25, which is this year, is how much? 16 lakhs. So we have to calculate the tax liability under the new regime, and the new regime is nothing but 115 BAC. This is the section. Okay, this is called the new regime, default tax regime. It's called default tax regime because this is the regime where you have to pay tax unless you don't choose to pay tax under this regime. You want to go for the old regime, then you can even apply under the old regime. Okay, that is your wish. So we'll understand that later. So if you have to calculate tax, so on first 3 lakhs, the tax is 0. Okay. On the next 3 lakhs to 7 lakhs, the tax will be 5%, that is 20,000. Okay. That's why, on the first 7 lakhs, the tax was 20,000 and you are not be paying any tax if your income is below 7 lakhs or 7 lakhs. But in this case, the income is 16. So this guy is not going to get 87A benefit. Okay. So then 7 to 10 lakhs. So 3 lakhs more, 10%, 30,000. Then 10 to 12 lakhs, 2 lakhs, 15%. Okay, so you can open your Excel sheet also. So that means the income is 16 lakhs. So it is above 15. So that means 30% on 1 lakh. So his total tax will be 1 lakh 70,000. So we have applied, the slab rates and calculated his tax on 16 lakhs. On the first 3 lakhs, no tax. On the next 4 lakhs, 20,000. On the next 3 lakhs, 30,000. On the next 2 lakhs, the tax is 30,000. And on the next 3 lakhs, the tax is 60,000. And then because it has become 15 lakhs, so above 15 lakhs, the tax rate is 30%. So on 1 lakhs, the tax will be, this thing. So that means here figure, but how we have arrived is, if you just go to the formula here, so basically, the formula says 16 minus 15, 1. Okay. So that means this tax liability will be, and then you have to pay 4% cess. So the tax rate says that you have to pay 4% additional, which is called health and education cess, which is again a tax. So his total tax liability will be 1,76,800 if he opts for the new tax regime. Okay. Is that clear? Yes. Okay.
Yes,
Now
sir.
let's say take an example 2. Okay. Okay. Okay, we are not taking the example 2. Now this is basically the slab rates for which were announced by Sitaraman in this budget. So this is applicable for the next year. Okay. So that means whatever earning I'll be making in 25-26, for that I'll be assessed in 26-27 because we are not going to understand this. Okay. This is only for the next financial year and next assessment year. So according to budget, it says that anybody who's income, the new slab rates are like this, which are more liberal now. Okay. And anybody who is drawing above around 12 lakh rupees, there will be no tax. Okay. So he will be getting a tax rebate, and up to 12 lakhs, there will be no tax. So we are not going into that at all. Okay. Because this is not applicable to us. for our questions and I mean set paper what we'll be doing, because we are going to make an for this assessment year we are more, I mean, because our all exams will be done on this rates and not on this rates. This will be applicable from the next financial year. Okay, so it says that a resident individual with total taxable income up to 2 lakhs, so there will be no tax up to 12 lakhs from the next year, but in our current year it is 7 lakhs. Okay, fine. So we are just moving on to the old. Now we come to the old regime. Okay, so an assessee has this thing. Either he can use the old regime, okay, the old tax regime, or he can go for a new tax regime. So under the new tax, old regime, uh, in individuals or even HUF or whatever, sorry, individual who is below 60 years, then up to 2,50,000 there is no tax. Okay, 2,50,000 to 5 lakh, 5%. Okay, 5 lakh to 10 lakhs, 20%. So these are the old regime tax rates. Now a person can always choose either this or choose the new one. Now, so what is the advantage of choosing the old one? A person, why he would choose? Because here the tax rates are much higher, okay, compared to this one. Okay, because here up to 15, after 15 lakhs the 30% slabs rate kicks in, whereas in the old regime, so it is up to above 30%, above 10 lakhs you have to pay 30% tax. Okay, now so this is up to the age of 60. Okay, so this is the old regime. Now we'll come to and understand why a person will go for an old regime later on. So if you are above 60 years but below 80 years, then the slab rate is up to 3 lakhs nil, 3 to 5 lakhs 5%, 5 lakh to 10 lakhs 20%, and above 10 lakh 30%. So if you can just see, only the advantage is up to 3 lakhs there is no tax for a person who is a senior citizen. Okay, so his tax rate starts from 3 to 5 lakhs. Okay, where the rate is 5%. In this case it was 2.5 lakhs to 5 lakhs, he was to pay 5%. So here additional benefit of 50,000 is given to a person who is above 60 years. Now, but he has to be below 80 years. So if you are above 80, then you have to pay tax only above 5 lakhs. So up to 5 lakh, there is nil tax, and 5 to 10 lakhs, the tax is 20%, and above 10 lakhs, 20%. So these are the three slab rates as per the old regime. So that means either if you are a person below 60 years, or a person above 60 years, or if you are a person above 80 years. Okay, fine. So these are the old regime. So we'll come back to this. So now if you are adopting a new tax regime, okay, so that means you are going to a new tax regime. So you have a choice. Either you go for this or you go for this. Okay. So what is that disadvantage in the new tax regime? In the new tax regime, you are not entitled for certain benefits. Okay. So you are not entitled for certain benefits. You can't claim exemptions. Now, government has been giving a lot of exemptions earlier. Okay. Now, government wanted to move out of these exemptions. So government says that you pay your full tax, don't claim any exemption. So that is the ultimate objective of the government. So government is gradually, shifting people from the old regime to the new regime, where there are no tax benefits available, no exemptions available. So no, what are those exemptions which will not be, allowed under the new tax regimes is, first is entertainment allowance. For example, if you are working in a government, or a private organization and you're getting some entertainment allowance, okay. Now this is exempt up to 5,000 in hands of government employees, but it is fully taxable. But it is fully taxable in the hands of private employees. So exempt up to 5,000 in the hands of government employees. So this is in the old regime. But the new regime, if you are a government employee, you will not get this 5,000 rupees benefit. So it's a small benefit which he loses. Okay. Then again, uh, as a, if you are working as a salary employee, then you have to pay a professional tax in every state like Delhi, UP, MP, whatever state you are working. So there is something called professional tax, which is about 200 or 300 rupees per month. So which comes to about 2,400 or something for the annum. So that whatever tax you pay is also allowed a deduction under the old regime. But in the new regime, you won't be allowed this deduction. So it's also a very small amount. Now, the third exemption which you get is called the LTA, Leave Travel Allowance. Okay, so this exemption is available in the old scheme, but in the new scheme, if you get an LTA, and then there will be no exemption available to you for an LTA. So the whole of your LTA will be taxable under the new regime. Suppose if for example, if an employee is getting a lakh rupees as LTA, so this will, under the old regime, he could avoid tax. But in the new regime, that whole of the amount will be taxable in his hands. Okay, fine. So then house rent allowance. If you are staying in a rented accommodation and you are paying rent and you are also getting an HRA from the employer, so there was a benefit which was given to under the old regime. So this benefit is also not available in the new regime. So these are the exclusions. Okay, if you see my slide, these are called block incentives. So that means there will be no incentive given for HRA. Then there are certain sections, section 80C. Here also you were entitled for a certain benefit under section 80C. Okay, then 80D, then 80E, then 80G, then 80TTA. So these are all the exemptions which are given, okay, to various individuals, and he can reduce his tax, okay, under the old regime. But in the new regime, all these 80C, 80D, 80E, 80G, and 80TA will not be available. Okay, for example, if he invests some money in insurance or public provident fund or national savings certificate or life insurance premium. So earlier I'll be discussing what was ATC scheme more in detail in today's lecture. So he could save his taxes by putting money into various schemes, which is like provident fund or national savings certificates or life insurance. So under the new regime, he is not allowed. Similarly, under section 80D, I'll be covering all these sections in detail, okay, but I'm just giving you a little bit of these things. 80D is that you take up a policy. Now, normally we, all take policies like, your parents might have taken up insurance policy for, for you and themselves. So something happens if you're hospitalized, then all the expenses are paid by the hospital, are claimed by the hospital from the insurance company, and nothing falls on your account. Okay, so you have to pay a premium. So that premium which you pay in the old scheme, that premium was also allowed as deduction. But in new scheme, you will not get any benefit of any premium which is paid on any insurance policy which you have taken, where you get a kind of a benefit of that you don't have to pay any money for all your hospitalization. So that benefit is withdrawn under the new scheme. So if you're chosen a new scheme, then you will not be get the benefit of whatever insurance you're paying. Okay, like insurance premium you're paying. Okay, fine. Now 80 is interest on education loans. Suppose you're taking a higher education. Okay, you're taking a loan, or for yourself, or for your spouse, or for your children. So in that case, whatever loan interest you are paying, so that was also allowed as a deduction. It will reduce your tax liability under the old regime. In the new regime, it is not allowed. Okay, 80G is yet another section where any donations which you give, like Prime Minister Relief Fund or some fund. So if you give some donation to some temple, charitable institution, Gurdwara, or somebody who are eligible to take donations under Section 80G, so it will reduce your income tax. Okay. Now under the new regime, you can't claim any benefit under 80G. So whatever donation you give, it is not going to reduce your tax. Okay, because you will not be eligible. Now under section 80A, 80TTA, interest on saving account. Okay, that means if you are, if you have a saving account and if you are earning some interest, so up to 10,000, it is totally exempt from tax. But in the new regime, whatever interest you are earning, it will be fully taxable and you have to pay tax on that. Is that clear? Chokalingam, Mananya, are you there? Anyone?
Yes, sir,
Okay,
it's clear.
so under 80C, 80D, 80E, 80G, 80TTA, all these exemptions will not be applicable to you if you opt for the new regime. Okay, so the new regime, you have to pay less tax, but you can't claim any deduction. Okay, now the other thing is set off of losses. Now suppose in case if you incurred a loss in the last year, okay, you can always claim that loss in the next year and reduce your tax liability under the old regime. We'll discuss that more in detail, but cannot be done under the new regime. Okay, like losses under the head income from house property cannot be set off against any other head of income. Now, suppose you have a loss. Okay, suppose under the income from house property, so that loss you can always claim under the old regime, but in the new regime you can't claim. So we'll discuss some examples of that sort when I do some questions. Okay, then similarly, other specific deductions like deductions on interest on housing loan for self-occupied is not permitted. So that means if you're paying any interest on housing loans, now normally we take loans, okay, for making houses and we have to pay interest. Now we take a loan from the banks and the banks charge some interest. So that also can reduce our income tax liability under the old regime. But in the new regime, it is not allowed. Okay. So these are some of the exemptions. Okay. So you mark these are the most important one. That's why I've given. There can be some more which I'm not talking about. Okay. So if you, I'll just show you that later on. Okay. So these are the some of the very important ones which covers almost like 90% of the cases. So that's why I've just given all that in this slide. Okay. Now let's take an example to understand that. So please open your Excel sheet. Okay. So first case is basically, if you are a person X and your age is 35 years and you're an individual, assuming your taxable income is 22 lakhs. Okay. That means this is your income and you're eligible for some benefit under section 80C and 80D. Okay. So this is 1,50,000 and 2,30,000. Okay, fine. Okay, case one. So without going and understanding what is ATC, ATD, little bit of knowledge. So assume these are the on under ATC your maximum allowed deduction is 1,50,000. ATD there is no limit as such, so it is 2,30,000. So if you have to calculate the tax, so under both the regime, old regime and new regime. So, in the old regime, he will be entitled for these benefits. So his net income will become 18,20,000. In the new regime, his total taxable income will be 22 lakhs. Is that okay? Have you opened your Excel sheets, please? So please open your Excel sheet so they can understand better. Now, that means if you just calculate the tax, so under the old regime, the tax comes to 3,58,000. Okay. And here it comes to 3,50,000 in the new regime. So the cess is 4%. It comes to 14,000. So total tax will be 3,72,000. In the new regime, it is 3,64. How we have calculated? It is like this. So this is what we have done. Okay. So if you just calculate this, so this is, is tax liability. If you just put the old regime or sorry, the new regime and just see the tax has been calculated for coming from here. Okay. Which is, the slab rate 3 lakh 0, then 5% like this, we have applied all the tax and calculated its tax liability here. Okay. Now under the the old regime, that means we have to calculate the tax as per the old regime, which is, because he's 35 years old. So up to 2,50,000 nil, 2,50,000 to 5 lakh 5%, then to 5 lakh to 10,000 20%. So we have applied all the taxes. His tax rate comes to, his rate comes to 3,58,000. Okay. So now tell me which scheme he will go for. Should he file his return in the old regime or new regime?
Sir,
In
new
the new regime,
regime.
he is paying 3,64 tax. Okay. And the old regime is paying how much? 3,72,000. So that means, he's getting benefit here. So even if, you invest all the money under, ATC and ATG, still, he has to pay more tax. So he just calculates his numbers at the beginning of the year. So he knows that even saving all the amount will not, reduce his tax liability. So he's not going to invest the money in this. Okay. So that means he's going to choose only the new regime. So you have to do a planning, whenever the new year starts. So you know that, what will be your income and how can you save your taxes. So whether you have to go for old regime or new regime. So then you plan. Like this year, I have not invested any money under section 80C or any benefit under schemes which I have told you. So I'm going to file my return under the new regime because the new regime seems to be more beneficial. Now let's take another example. Okay. So another example again, this is a case 2. Okay. So I will say call it case 2. Okay, where you are again 35 years old, your income is from salary. Okay, so you are earning 2 lakh rupees per month. Okay, and you have a benefit under section 80C, 50,000. 80D, like health insurance. 80T is like interest on your bank account. Okay, just I'm giving you, but we're going to talk more in detail of that. So suppose this is what is given to you. Now, the taxable income in old regime and new regime is same. Okay. Now, under 80C is going to get a benefit of 50,000. Under 80D, 5,000. Under 80D. Now, if you're a salaried person, you will be also entitled for a standard deduction. Okay. So, which is 50,000. So, in both cases, you will be getting a benefit of 50,000. So, this is only available if you are a salaried person. If you are working in a company, so you get another benefit of 50,000. Okay, that's the maximum exemption you can get. Okay, so if your salary is above 50,000, you will get 100%. Okay, if your salary is below 50,000 rupees per annum, then you will get that much amount. But mostly people will be getting full amount. Okay, 50,000, because salary of 50,000 rupees for the whole year is very small. Okay, fine. So that means this is the net income, and the tax comes to in the old regime, the tax rate comes to 5 lakh 17. In the old new one, it comes to 4 lakh 10,000. Okay, so similarly, we can see his tax I mean, under the old and new. So under the new one, so this is the rate. Under the old one, it is like this, which is given here, 4 lakh 98,000. So now tell me which scheme he will go for, old or new, other than Mananya Chokalingam. Which scheme is going to benefit go for? Should he file his income tax return under the new scheme or old scheme? Mananya, are you there? So
Yes, sir.
बाकी कोई
Sir,
बोलने
should I
में?
answer?
Okay, so Mananya,
So the
new
new
regime. So new
regime,
regime, what is the tax?
4,10,800, which is
far less
far
than
lesser.
the old regime where he's to pay 5 lakh 70,000. Okay, so now, so let's do
Yes.
another exercise. Okay, so the question in your exam will be like this. Okay, fine, but we will solve this question only after we understand a little bit more. Okay, so first read the question on Mananya.
Mr. Anil Kapoor, aged 45 years, is employed as a marketing manager in a private company. During the financial year 2024 to 25, he received the following income and incurred the following expenses. Income details: basic salary rupees 1,80,000 per month, house rent allowance rupees 30,000 per month, special allowance rupees 20,000 per month, interest on savings account rupees 18,000. Investment and expenses: contribution to Employee Provident Fund rupees 60,000 per annum, life insurance premium rupees 45,000 per annum, policy taken in 2020, health insurance premium rupees 40,000 per annum for self and family, no senior citizen, investment in Public Provident Fund rupees 50,000 per annum, donation to PM Cares Fund rupees 30,000, eligible for 100% deduction under Section 80G. Other information: he lives in a rented house and pays a rent of rupees 40,000 per month. No other income or deductions. Sir, should I read the tasks part as well? Tasks: A. Compute the tax liability of Mr. Anil Kapoor for the financial year 2024 to 25, assessment year 2025 to 26 under old tax regime. Consider all eligible deductions under sections 80C, 80D, 80TTA, and 80G. Calculate HRA exemption based on the following conditions. Actual HRA received: 50% of salary since he lives in a metro city, rent paid minus 10% of salary. New tax regime: standard deduction of rupees 50,000 is allowed, no other exemptions or deductions except the standard deduction. B. Suggest which tax regime would be more beneficial for Mr. Anil Kapoor and why. Show all calculations and justify your answer with proper explanations. Hint: use tax slabs applicable for assessment year 2025 to 26 for both
so
regimes.
This is the question. Okay, So what we are going to do is we are going to just see the solution. Okay. Uh, okay. We are going to learn about, the HRA, exemption, like, what kind of an exemption is available and what is the income tax, benefit which is given if you are staying in a rented accommodation. But some information is given in the question itself. So we are going to use that and let's solve. Okay. So, first, we are going to calculate is what is his annual salary. Okay. So, and without going in and understanding the whole of the exemptions like ATC, HRA, I'm just explaining. And now, and then we are going to understand all these exemptions. Okay. Fine. At a later part. Okay. So let's understand his basic salary is how much? 1,80,000. So multiplied by 12. So that means his total income, annual income will be 20 lakh, 21 lakh 60,000. Okay. His HRA, he is getting 30,000 rupees HRA per month. For the 12 months, he will get 3 lakh 60,000. Special allowance which is getting 20,000 for 12 months. So that means his total money which is going to receive from his employer is 27 lakhs 60,000. Okay. Now, first we talk about the HRA exemption. Okay. So what is the HRA? He is going to receive 3 lakh 60,000, which is given here. Okay. Since he's staying in metro, so what we do is we calculate 50% of the basic salary, which is 50% of 21 lakh 60,000. So which comes to 10 lakh 80,000. Okay. So then the rent paid minus 10% of the salary. So how much rent he has paid? He has paid 40,000 rent, which is given in the question. So that means 4 lakh 80,000. And 10% of the salary is what? 21 lakh 60,000 cut 10% comes to 2 lakh 16,000. So excess of rent paid is 2,64,000. So that means, the rent paid minus the 10% salary is 2,64,000. Now, we have calculated three numbers. One, actual HRA. Second, 50%. Because in metros, if you're staying, 50%. If you're not staying in a metro, then this figure becomes 40%. We'll understand that. So rent paid minus 10%, which remains the same for all the cases. So rent paid minus the 10% salary, which we have calculated is 2,60,000. Okay. So HRA exemption is minimum of the above. So HRA received 3,60,000, 50% of the basic rent paid. So HRA exempt would be only 2,64,000 because out of these three, which is the minimum, 2,64,000. So this will be exempt. Okay. So which means if he's getting 3,60,000 from his employer, okay, how much is getting 3,60,000, which means that he has to pay tax on 96,000. Okay. So how we have calculated? We have calculated the three numbers, number one, number two, number three, and then the least of the three is exempt. Okay. So here the least of the three is 2,64,000, which is rent paid minus 10% of the salary. Okay. So this is exempt. How much he is getting? 3,60,000. Okay. So 360 minus 2,64,000, that means on 96,000 he is going to pay tax. Okay. So this is under the old regime. He'll get the 2,64,000 will be exempt out of 3,60,000. So he has to pay tax only on 96,000. But under the new regime, he'll not be able to. Entire 3,60,000 will be taxable. Okay. Under the new regime, everything will be taxable. So under the old, he'll get exemption for 2,64,000 and he has to pay tax only on 96,000. Now, let's talk about, the section 80C. Now, under section 80C, the maximum deduction allowed is 1,50,000. Okay. So he has contributed, he has given an EPF contribution, Employee Provident Fund scheme. Okay. Like when you work in a company, what happens is that, some money is contributed to a scheme which is called Employee Provident Fund. Okay. So how much he has contributed? 60,000. So which is, below 1,50,000, 100%. He has also taken a life insurance policy for which he is paying some premium, 45,000. Then he's also making a public provident fund. Okay. Public provident fund is basically you go and open an account with any bank in India. Okay. And deposit some money there. Okay. So if you deposit in that account, you will be eligible for a benefit under section 80C. So all this amount comes to how much? 1,50,000. But the total amount capped benefit is 1,56,000. So he'll get only a benefit up to 1,50,000. Though he has, paid how much? He has paid 1,55,000, but he will be getting the benefit of 1,50,000 under section 80C. Okay. Now this will be only applicable under the old regime. And he has also paid he has taken an insurance policy for, for himself and his family. the maximum reduction available under the insurance policy is 50,000, okay, which we are going to learn very shortly. So he has paid a premium of 40,000, so that means he will be entitled for the entire 40,000 benefit. Then interest on saving account. Suppose he is maintaining some saving account, so any interest which he earns up to 10,000 will be totally exempt. He doesn't have to pay any tax on any interest which he is earning. So he has earned 18,000. Okay, so that means eligible deduction will be 10,000. So that means he has to pay tax on 8,000 under the old regime. Okay, now donation. So under donation, he's deposited money under the PM cares where he's entitled for 100% deduction. Okay, so all the entire donation will be, exempt from. So fine. So donation amount 30,000, eligible 30,000. So now we can just see, what all money he has paid under the old regime. 80C, 1,50,000. 80D, which is the health insurance. 80TTA, which is the interest up to 10,000. 80G, the insurance to the provident this thing. So total deductions is 2,30,000. So now we can just put the numbers here. Okay. So, gross salary is, let's see the old regime first. So here, he'll be entitled for standard deduction, HRA exemption will be given to him. Then all the benefits of 2,30,000. Okay. So which we can just see it's coming from, here. Sorry. So this is the amount. So I could have linked this with this. Okay. So this is coming from here. Okay. So if you just see, this is coming from here. Okay. So total income is 22. Okay. So first we are talking about the old regime here. Okay. Fine. Okay. So old regime. So this is 22 lakhs. Now standard deduction is 50,000. 22 lakhs. Okay. So this is the old regime. So what happened is that he has got the standard deduction here. It is, there's no standard deduction. Okay. Fine. So this is what we have done. Okay. So that means what we have done is that is taxable under the old regime is 22 lakhs 66,000 because I have included the standard deduction here. Okay, which I have included here also. So ultimately his net income is 22 lakhs 16,000, which is the same here coming here. Okay. Okay. So if you just see, it is the same here. Okay. Which is the same amount 22 lakhs 16,000. New regime, how much he is getting? 27 lakhs 60,000 without any reduction. Okay. Fine. 27 lakhs 60,000, which is coming from here. 27 lakhs 60,000, which is the entire amount. Okay. Without any reduction, which is coming from, sorry, here this amount. The gross salary is 27 lakhs 60,000. Okay. Without any reduction under the new tax regime. But under the both the schemes, they will get the standard deduction. Okay. So the net income is, the tax is for 4,77,000. Here the tax is 5 lakhs. So under the old regime, the tax is 4,96,000. Under the new regime, it is 5,23,000. So we can just see how it has been calculated. So, so this is coming like this, and under the this is coming from here. Okay, 4,77,000. Okay. So now, which is better for him? Should he file his income tax return under the old regime or new regime?
The old regime, sir.
The old regime, the tax liability is coming only 4,96,000, whereas the new regime, it is coming 5,23,000. So what he has done, he has already saved a lot of amount. So he would be, he has already planned it. So he has come to know that, he knew that old regime, he's going to save a lot of tax. So in this case, the old regime seems to be more beneficial. Okay. So you have to do a lot of planning at the beginning to understand, whether the old regime is beneficial or new. So if you have a lot of exemptions, okay, like, you are having exemptions, like 2,30,000 exemptions under the various this thing, okay, and the HRA exemptions. So most likely it will happen that you will be entitled for, you will be more beneficial under the old regime. Okay, so you have to make a choice. So we'll come back to the solution again. So let's understand what is 80C, and let's understand all this a little while, and then we'll just close today only after understanding all this. Okay, and again revisiting this solution. Okay, so ATC. Okay, so let's understand what is ATC. Mananya, can you read?
Yes, sir. Section 80C of the Income Tax Act 1961 allows individual taxpayers and Hindu undivided families (HUFs) to claim deductions from their gross total income, reducing their taxable income. The maximum deduction limit under this section is rupees 1,50,000 per financial year. Key investments and expenses eligible for deduction under Section 80C: Employee Provident Fund, contributions by employees to EPF account, rupees 1,50,000
Okay, just hold
combined
on.
limit,
Whenever you are
public.
working in a company, as per the Government of India regulations, you have to contribute some amount to employee provident. All employees who work in India, they have to contribute some portion of their salaries. Okay, normally it is around 10%. Okay, so 10% of salary is deducted and it is deposited under the employee provident fund. Okay, a similar amount is also contributed by the employer, and that will go into a separate account. And at the time when you retire from the company, okay, or leave the company, you can just get back your amount. Okay, and if you remain till at retirement, you will be also entitled for some pension from this account. Okay, and you can take some loans also from the provident fund after you have worked for some certain number of years. Okay, so this is number one. Number two.
Public Provident Fund, deposits made in a PPF account, 15-year tenure, rupees
Okay,
1,50,000
normally,
combined limit.
what happens is that, because not all the people are working in companies, so it can happen that people are doing, they're self-employed, they're doing business, okay? And even a person who is not working in a company also, he can also participate in this scheme. He can, open an account with a bank, which is a 15-year scheme where you keep depositing every year a certain amount, depending upon your own choice. It can be 10,000, it can be any amount, 20,000, 30,000, whatever. So maximum reduction is 1,50,000. Okay. So you can, and this is a combined limit. Okay. So you can keep depositing that money, and after 15 years, along with interest, you will get your amount. I remember my father who was not working as an employee in any company, so he was running his own business. So, he used to go and, deposit some money every year in a public provident fund. Okay. Now, in my case, I was an employee, so I never opened any PPF. So, I was having an employee provident fund because for 20, 25 years I had worked in various companies. But my father was a businessman, so he didn't have any choice. So he had to put some money in a PPF account, and maximum exemption was 1,50,000. So normally the self-employed people will normally go and open a public provident fund. Of course, even an employee of a company, he can also open a public provident fund. Then comes the next one. Just read this.
National Savings Certificate (NSC), investments in NSC issued by post offices, rupees
Okay,
1,50,000
now
combined
this was the
limit.
very, very, very popular scheme earlier. Okay, and I have deposited every year. We used to deposit and take national savings certificates because we will be always be having some kind of a money which we can save and reduce our income tax, because the employee provident fund would not cover entire 1,50,000. So because there is a huge amount of exemption available, so we will buy some national savings certificate from the post office. So they will look like this. Okay, so we used to have a lot of paper like this at home, and after 5 years we used to go back to the post office and deposit this and get our money back. Okay, so this will be like national certificate of 100 rupees, so we'll have 5,000, 10,000 like this denomination. So a lot of people, if you ask your parents or grandparents, so they have been investing in these schemes quite a lot. Then further.
Tax saving fixed deposits, bank FDs with a minimum lock-in of 5 years, rupees
Now,
1,50,000 combined
instead
limit.
of going to the post office, the new which came, after that only. I mean, of course, this started about 10 years back, and this has been there for last 30, 40 years. So the tax saving fixed deposit. So if you open a fixed deposit in a bank, okay, where the minimum lock-in period is 5 years. Okay. So if you deposit a fixed deposit for 5 year lock-in period and you say that this is for my ATC benefit, so they'll give you a certificate. This FD will be entitled to get a tax benefit. So many people, instead of going to the post office, they were deploying their money in a fixed deposit in a bank, which is locked in for five. That means for 5 years you can't take your money out. But normal FD, you can always, prematurely encash them, but here you can't encash them. Okay. Then further,
Equity Linked Savings Scheme (ELSS), investments in tax saving mutual funds, lock in of 3 years, rupees 1,50,000
now this
combined
was the,
limit.
when the scheme came, so this became, the most important one. So everybody, gravitated to this scheme. So, because it was linked to the equity schemes, so where, the chances of return are about 14 to 15%, but you have to, there is a lock-in for 3 years. So if you put your money and give the money to a mutual fund, which is running a ELSS scheme, up to 1,50,000, there is an exemption, and the money will be blocked for 3 years. So whatever returns you're going to get from the mutual fund, that will be the return what you will get. So this was offering the maximum returns. Okay, when I left the company and started my journey of a visiting faculty, so I was putting my entire money under ELSS. So I was depositing 1,50,000 rupees in mutual funds every year, myself and my wife and my HUF. So we are putting all the money here. So all these schemes became almost irrelevant. So equity linked schemes were the most, favored schemes in this era. Okay. Then
Unit Linked Insurance Plan (ULIP), investment cum insurance plan, rupees
now,
1,50,000
there is
combined
something
limit.
called, where the money is going to equity market, but some amount is deducted for your insurance. So that means it is like a mutual fund, but here some part of the money goes for your insurance. That means if something happens to you, then your spouse and your children will get the money. But this is like a unit link insurance, like a mutual fund, but it is a combined product which gives you insurance as well as for a return like a mutual fund. Okay. Then
Life Insurance Premium, premium paid for life insurance policies for self, spouse and children, rupees 1,50,000
now, this was
combined
also a
limit.
very popular scheme, very, very popular scheme in our era, where, we used to always take a LIC policy. Always you'll find an agent coming to your door and offering a LIC policy because, we will be entitled for that rebate under income tax. Okay. So this is also was one of the very popular schemes in our time. Okay. Then,
Senior Citizen Savings Scheme (SCSS), deposits made under SCSS for individuals aged 60 plus, rupees 1,50,000
okay, go ahead
combined
again.
limit.
Next one.
Sukanya Samriddhi Yojana, deposits made for a girl child's account under this scheme, rupees
Okay,
1,50,000
these two
combined
schemes were
limit.
started, quite recently, where one is called the senior citizen, and is called the Sukanya Samriddhi. So here also both the schemes qualify for benefit under Section 80C. The overall limit is 1,50,000. Then,
Principal repayment on home loan, repayment of principal amount on housing loans, rupees
okay,
1,50,000
now
combined
if you have
limit.
taken a housing loan and if you are making some principal payment to the bank, now the bank is going to charge an EMI. Okay, so out of the EMI, whatever is going for principal repayment, so up to 1,50,000, that is also qualifies for ATC. So this was a kind of a big relief, people who were making houses. So since they were paying their money to the bank and they were left with nothing to put the money in other schemes, so the government allowed that whatever principal repayment you are making, so that will be also allowed as a reduction. Then,
Stamp duty and registration charges paid for purchase of a residential property, rupees
now,
1,50,000
this was an
combined
additional
limit.
thing, like whenever you buy a house, okay, you're taken a loan and or even if you're not taken a loan, if you buy a house, you have to pay a stamp duty, okay, like, and registration charges. And at the time the house will be transferred in your name, so normally it is in the range of 4 to 6%. If the house is in the name of a woman, then the stamp duty is 4%, and if it is in the name of a male, it is 6%. Now it all depends upon state to state. In state of Haryana or Delhi, it is like 4 and 6. I don't know the current one, but this is the rate which I paid, when I bought a house. So these rates will keep on changing. So now whatever money you pay as a stamp duty or registration charges, that will also qualify for deduction. That will be qualifying deduction in that year only when you buy a house. Okay. When
Tuition fees for up to two children's education, excluding donation and development fees, rupees
now
1,50,000
this is also
combined
very
limit.
good, tuition fee, because it happens that your children are studying in school or colleges. Like, I used to also claim the tuition fee also. This also started very late, But my son was studying, so I used to claim his tuition fees and reduce my income tax liability. Okay. Then
National Pension Scheme (NPS) Tier 1 contributions up to rupees 50,000 under Section 80 CCD 1B rupees
so here
50,000
basically
additional.
if you go for this scheme, which is called the National Pension Scheme, so there you are allowed for another 50,000 apart from 1,50,000. All this. So if you have also taken a contribution and paid some money to the National Pension Scheme, then you will be entitled for another 50,000 rupees benefit. Okay. Then finally,
Infrastructure bonds. Investments in specified bonds rupees
so
1,50,000
these are,
combined
the
limit.
long list which ends here. So they're almost like, 2021 kind of a schemes where you can save money, or rather starting from 9 till 22. Okay, so almost like 15, 16 schemes where you can put your money, and the maximum exemption limit is 1,50,000. But barring this, if you deposit your money in national pension scheme, additional 50,000 rupees benefit is given. So overall, this scheme gives you a benefit of 2 lakhs. Okay, but under one category, you can deposit 50,000. Okay, rest are all 1,50,000. Okay, so important points to note: maximum deduction. Just read that.
Important points to note: maximum deduction limit. The total deduction limit under Section 80C, 80CCC, and 80CCD1 combined is rupees 1,50,000. An additional deduction of rupees 50,000 is available under Section 80CCD 1B for
So that means
NPS
what he's saying is that the
contributions.
maximum reduction is 1,50,000, and another 50,000 if you are putting your money under the national, public national pension scheme. Okay, fine. So these deductions are available under Section 80C and 80CCD. Okay, or 80CCD 1B. Anyway, so these are the exemptions. So lock-in period. Just read.
Lock-in period: ELSS 3 years, PPF 15 years, tax saving FD 5 years, NSC 5 years,
So
ULIP
that means
5
if
years.
you're taking a ELSS, that means you're depositing your money in a mutual fund where the lock-in period is 3 years. Okay. So there the lock-in period is 3 years. It's called ELS. So normally, all the people who are not working in a company, they were going to put all the money under ELSS. Or even a person who is working as an employee. So whatever is the amount left after, I mean, within 1,50,000, he's going to put money in a mutual fund. Public provident fund is basically you go to a bank and open, like my father was doing. Tax savings FDs, which are a 5-year lock-in period. National savings certificates was a very popular scheme earlier, 5 years. So these are lock-in periods. So that means if you put your money on all these schemes, you are not going to get your money immediately. So there are some lock-in periods, okay, ranging from 3 to 15 years. PPF is the longest, okay. So now just read this one, okay. Eligible taxpayers, just forget the LIC.
Yes, sir. Life insurance premium conditions should not exceed 10% of the sum assured for policies issued after April 1st, 2012, should not exceed 20% of the sum assured for policies issued before
So
April 1,
that means,
2012.
here they are saying that, if you're taking a policy, so if you're taking a policy now, which is after April 1st, 2012, the premium should not be more than 10% of their sum assured. Suppose, you are covered for 1 lakh rupees. Okay. So the maximum premium is 10,000. Earlier, 20,000 was allowed, but now they say that your premium cannot be more than 10%. Okay, this is a small this thing. Eligible taxpayers, individual taxpayers, and Hindu undivided family. So this all these benefits are given to individual and HUFs. Okay, so this is 80C. Now 80D will go to. We'll read.
So, will we have to learn all of that
No,
for the
not at all.
exam?
Not at
Okay.
all. Okay, because there can be two ways. One can be the exam can be open book. Okay, so let's discuss that for a while. Just have a little bit of this thing. So exam can be open book. Okay, how many students are there? 19 students are there. So the one possibility is that I'll give you an exam which will be an open book exam. Okay, where you don't have to learn anything, but you should know where your material is so that you can always lay your hand and solve the question. Okay. The other would be that it is a closed book where you have to, the question will not be, that difficult, so that you can, if it is open book, the question will be slightly difficult. If it is an closed book, then the question will be very simple. Okay, so you can even solve them without any problem. Okay, Mananya, are you there? Yeah. Suryansh Gupta? Yeah, Suryansh, tell me.
Yes, sir.
Oh, sorry, sir. I
Acha, by
did that
mistake.
by
Okay.
mistake.
So you don't have to worry, because if you don't have to remember all the sections and all the details, because if you are doing CA, then of course you should know all these things and you should remember each and everything. But since you're not doing a CA course, so it is a course where you don't have to remember. Okay, fine, because the law is so vast, it's very difficult for anyone to remember each and everything. Okay, so is that clear? Chokalingam, Yash, Suryansh, Mananya. So what
Yes,
I'm
sir.
saying is,
Yes,
yeah, if the
sure.
question paper is very simple, then I'll keep it closed book. If the question paper is slightly difficult, I'll take your poll on that. So if you want that it should be open book, I'll can give a open book. Okay, but that call will take when I'm there. We are having a physical class, and most of the students are there. Then we will discuss that and sort out that matter. Okay, but don't worry, you don't have to, yeah, you don't have to
Okay,
worry
sir.
about you don't have to remember in any case. Okay.
It won't be a theory-based question paper, right? It will be all based on the
It will be based
Excel
on the
sheet
Excel
only.
sheet only, and you have to solve all the question on Excel sheet. If there is a Excel sheet question, then the section details will be given in that. Okay, if it is a closed book, okay, so entire ATC section will be given to you in the question paper itself. So you don't have to remember that. Okay, fine. You got me, Ananya? So when the
Yes,
question
sir.
paper will
Understood.
come to you, the relevant law will be given and explained to you on a question paper itself. So you don't have to refer back. Okay. Suppose it's a closed book. The law will be given to you that how much deduction is available. So you can just read that and apply that. Okay. Fine. Okay. So
Yes, sir. Fine.
80D. So let's just, do it for another 10 minutes and then we'll close. Okay. Fine. 80D. Read this, Mananya.
Section 80D of the Income Tax Act 1961 allows deductions for health insurance premiums paid for self, family, and parents. This deduction also covers expenses for preventive health checkups and medical expenses for senior citizens
Okay,
without
so that
insurance.
now I'm just going to explain that. You don't have to read now. So 80D is basically if you take a health cover. That means if you take a policy, okay. Now, if you remember during COVID time, many people were getting hospitalized and there were huge bills which were to be paid. So in case if you were covered under the insurance policy, so you were not, the insurance, the hospital was claiming that money from the insurance company rather than you have to pay, But after that, what has happened? The premiums become very high. Okay, currently you have to pay a lot of money to take an insurance cover. Now, currently I'm paying almost a lakh of rupees for myself and my wife because of the age also it goes up. But if you are young, it will be less. Like my son is paying around 25,000 for himself and the wife of my son. So the whole insurance is for 25,000 rupees. So it all depends upon your age and what bracket you are. Okay. So this is basically how much deduction you are available. Just read this, Ananya. Who is covered?
Self, spouse, and dependent children, rupees 25,000 for individuals below
So that
60
means
years of
if you are
age.
self, spouse, and dependent. Okay. If the age is below 60 years, then maximum reduction is 25,000. Okay. Next.
Parents below 60 years of age, rupees 25,000, premium paid for parents
So
even if
that
they are
means if
not
you're covering
dependent.
yourself, your wife, children, and your parents who are below 60, then the maximum reduction will be 25 plus 25. Okay. Then further.
Self, spouse, and children above 60 years of age, rupees 50,000 if the eldest member is a
Okay.
senior
Now,
citizen.
this applies to like me, like I covered myself and my wife. Okay. Fine. My children, they have taken a separate policy. Okay. Because they have a separate unit. So maximum reduction available to me is 50,000. Because if a person is above 60, then this exemption goes to 25. Though I'm paying a lakh of rupees, but I'm entitled 50,000. Okay. Fine. Okay. Further.
Parents above 60 years of age, rupees 50,000, premium paid for
Okay.
senior
If you have
citizen
your parents
parents.
also who are above 60 and you are also above 60, then the maximum reduction will be 1 lakh rupees for yourself and your family and your parents. Okay, fine. Is that clear? Okay. So now we go to
Yes, sir.
80G. Rest you can just read it yourself. Okay, 80G, which is the exemption for giving donations. Okay, read this.
Section 80G of the Income Tax Act 1961 allows taxpayers to claim deductions for donations made to specified funds, charitable institutions, and relief funds. Key features of Section 80G: eligibility, available to all taxpayers, individuals, HUFs, companies, and firms. Both residents and non-residents can claim this deduction. Mode of payment: donations must be made via check, draft, or digital modes to qualify. Cash donations exceeding rupees 2,000 are not eligible for deduction. Deduction limit: up to 100% or 50% of the donation amount, depending on the institution or fund, with or without a qualifying limit
Okay.
as
Now,
explained below.
this is an exemption given for giving donations. Okay. Now, you can give a donation to a charitable organization or to the Prime Minister Relief Fund or any fund. Okay. Now, this exemption is available to individuals, HUF, companies, and firms. Okay. Both resident and non-residents can claim this deduction. Okay. If you are a resident person or a non-resident, you can still claim. So, we are going to talk about who is resident and non-resident in the next class. Okay. Mode of payment: donation should be paid through check or through online mode, not in cash. So cash donations only up to 2,000 are eligible. Above 2,000, it should be all paid either online or through check. Now, the maximum deduction which is allowed is 100% or 50%, depending upon where you're giving. Okay. Now, for example, if you're giving to a Prime Minister Relief Fund, okay, like a PM, so there is no upper limit, 100% deduction. But if you're giving to some Jawaharlal Nehru Memorial Indira Gandhi Fund, then 50% without any limit. Okay. Okay, fine. If you are giving your money to a government or approved institution of promoting family planning, then 100% of donated amount. Okay. But for all the schemes, I mean, apart from this, the maximum deduction is allowed is 10% of your total income. Suppose if your income is 1 lakh rupees, the maximum donation you can do is only 10,000. Okay, this I'm just giving you a number, but for PM Relief Fund and for Jawaharlal Nehru, there is no limit. Even if your income is 10 lakh rupees and you're giving entire 10 lakh rupees as donation, you will be entitled for this thing. But if you are giving to any charitable institutions or NGOs, then only up to 10% of the income deductions can be given and you will be allowed deductions. Okay. Then last one, if you're going to talk about, so this is 80TTA and 80TTB, and then finally 80E. Yeah, 3 are left. Okay, I'm just going to cover them quickly, and then we can end the lecture for today. 80TTA. Mananya, can you read?
Section 80TTA of the Income Tax Act 1961 provides a deduction for interest earned on savings account held with banks, post offices, or cooperative societies. This deduction is available to individual taxpayers and Hindu undivided families, but not to senior citizens, who can instead claim benefits under Section
Okay, now just to
80TTB.
tell you that this is an exemption which is given on any interest which you are getting on a bank account. Like suppose you have a saving account, okay, you get some interest every quarter. So the saving account with bank, post office, and cooperative side. Suppose you have a saving bank account, okay. So you will whatever interest you earn from these saving accounts, you will be entitled for a deduction. So what is the maximum amount? Just read this maximum amount.
Maximum deduction limit: up to rupees 10,000 per year on interest earned from all eligible savings account combined. If the interest earned is less than rupees 10,000, the actual interest amount is deductible. If the interest earned exceeds rupees 10,000, the deduction is capped
So
at
that
rupees
means
10,000.
in case of 80 the maximum deduction allowed is 10,000 rupees. Even if you are earning more than 10,000 as interest on from all your accounts, so maximum deduction will be 10,000. Suppose you are earning 15,000 interest, okay? You will be entitled for 10,000. So you have to pay, 5,000, you have to pay tax on that, okay? Now this is available to only people who are below 60. But if you are above 60, it says that you are entitled for a deduction of, I'll just read this.
Section 80TTB of the Income Tax Act 1961 provides a deduction on interest incomes earned by senior citizens from deposits held with banks, post offices, or cooperative societies. This section was introduced to offer higher tax relief to senior citizens compared to Section
Okay, read this.
80TTA. Who can claim? Senior citizens aged 60 years or above at any time during the financial year. Eligible deposits, savings account, fixed deposits, recurring deposits, and post office deposits. Non-eligible assessee. Individuals below 60 years and Hindu undivided families cannot
Okay,
claim this
now this
deduction.
benefit can be only claimed for individuals who are above 60 years. And what is included? Saving bank account interest, fixed deposit. Now, individuals below 60, they can't claim any interest benefit on fixed deposit, whereas senior citizens can claim even the interest earned on a fixed deposit is also eligible, even on recurring deposits. Okay, whereas recurring deposit and fixed deposits are not eligible for individuals below 60 years. But if you are a senior citizen, then all interest which you're earning, either it is a fixed deposit or a recurring deposit or a saving account, it is in a bank or in a post office or a cooperative site, all are exempt. Okay, only 60 years and above people can claim, none else. Okay, and the maximum deduction is how much? Just read this maximum deduction.
Maximum deduction limit up to rupees 50,000 per year on interest income from all eligible deposits combined. If the interest earned is less than rupees 50,000, the actual interest amount is deductible. If the interest earned exceeds rupees 50,000, the deduction is capped
Okay,
at
so in
rupees
nutshell, if you are
50,000.
above 60 years and if you are earning an interest, of 50,000, you don't have to pay any tax on that. But if your income on interest is above 50,000, then you have to pay tax on that only to the extent whatever it exceeds 50,000. Now, the interest which you earn from fixed deposit, recurring deposit, saving account, whatever, all qualify under this deduction, 80TTP, irrespective whether you're having an account with bank or a post office or a cooperative bank. Okay. Whereas if you are a below 60 years guy, then the exemption is only 10,000 and it is only interest on saving accounts and nothing else. Okay. Last one, 80E. Okay. Read this.
Section 80E of the Income Tax Act 1961 provides a deduction for the interest paid on education loans taken for higher education. This deduction is available to individual taxpayers and is applicable irrespective of the
Okay,
amount of
now here,
interest paid.
this exemption is basically if you have taken a loan, okay, for educating yourself or your family, then the interest which you are paying is eligible. You can, reduce your tax liability and there is no upper limit. Okay, whatever interest you pay to the bank, it will get fully qualified. Okay, who can claim? Individuals and HUFs, both, and companies cannot claim. A loan type, education loan for higher education. Purpose, to fund higher education for self, spouse, children, or a student for whom the taxpayer is a legal guardian. Loan must be taken from financial bank or approved charitable trust. Okay. Uh, Fine. So if you have taken a loan, then it will get. And maximum deduction, just read this, the last one.
Maximum deduction limit, no upper limit on the amount of interest that can be claimed as a deduction. The entire amount of interest paid on the education loan during the financial year can be claimed
Okay,
as a
so this
deduction.
is that there is no upper limit here. So whatever interest which you are paying to a bank for taking a loan, which is called the it's called the education loan, either for yourself or your spouse, your children. Okay, so that is fully exempt. So whatever interest you pay, it will get reduced from your income and you have to pay less tax. Okay, so that ends the lecture for the day. Okay, so attendance will be given to all of you. Okay, to the entire. So I'll give attendance to everyone. Okay, fine. Is that clear? Okay, then
Okay,
see
sir.
you on next Friday. Bye.
Yes,
Okay,
sir.
bye.
Thank you, sir.
Bye.
Thank you, sir.